Antoinette, to kick it off, how important to have target date funds become to the American retirement system?
Actually, quite important. And it's almost a little bit of a serendipitous situation that, kind of they were introduced as a solution to a default allocation in 2006 and have grown from there. But they really have had a very successful rise since then.
And how have target date funds affected the proportion of wealth that households invest in the stock market?
That's actually a very interesting question because you see, they haven't necessarily affected how much people put into retirement savings. According to research I have done with my colleague Jonathan Parker and a PhD student of us, Alison Cole, we actually see that they don't necessarily increase the amount people save, but the way people allocate their retirement savings. And it has led to a situation where basically people are now, especially in young age, putting more money into the stock market, therefore, in a way, taking more risk. And when people become older, these retirement saving target date funds automatically allocate more and more into less risky assets like fixed income. And so we see basically that with age, people are therefore then allocating more to bonds and fixed income and less into the stock market. And that has changed really dramatically since the introduction of target date funds.
So it hasn't affected savings behavior, but it's affected asset allocation behavior. What were people doing before? Like, what's the difference?
Yeah, the difference, interestingly, was that before the 2000s, people didn't really reallocate their savings over their life cycle. So even say older people that were close to retirement, in a way, got stuck with the same allocation that they were in when they opened the account. In addition, we also saw that in the past, people actually allocated much less on average to equities. So, in the pre-2000 period, lots of people, or the average person, had more around 40 to 50% of their retirement savings in equities. And we are finding that people have almost 70% in equities nowadays.
Interesting.
Very interesting.
Probably a good thing, right?
Yeah, I mean, so it's a good thing in the sense that, we know that there's an equity premium, right? So because you're taking risk when you're investing in equities, on average, investors want to be rewarded for that risk that they take. And therefore, are expecting to have a higher return on the risky part of their portfolio. Now, of course, they're taking risk. If you are unlucky, and we have seen, right, that unfortunately the market sometimes goes down, and if you are hit with one of those negative shocks close to your retirement, then you have very little time to make it up if you want, right? And that's why we often think that it is sensible that people take less risk when they approach their retirement age.
How have the target date funds affected the trading behavior of the retail investor?
Yeah, so actually, at least according to our research, not so much. And this might be, it's somewhat surprising to you, but the reason is the following. The average American, unfortunately, actually looks at their retirement savings, right? Their 401k very rarely. In fact, we find that people actually log into their retirement accounts as little as, on average, once every 1.5 years. So that's shocking, right? I mean, so they are definitely, people are not day traders in their retirement savings accounts. In fact, I would say they may be even looking at it maybe a little, too little, right? Because you want to be aware of what you're doing in your retirement account. Now, of course, there are people, right, who have brokerage accounts and so on, and they are trading quite a lot in those accounts. But in their retirement in 401ks, it hasn't affected people's active trading. But you see, in a way, the target date funds were meant to help with the fact that people pay so little attention to their retirement savings. And what the target date fund does, right, is that when, say, the stock market goes up a lot, it automatically rebalances you out of stock and into a little bit out of stock, right, and more into a fixed asset, so that you're back to your target allocation for your age group. Right. And so given that we see, even in our data, right, that in the past, people didn't do that. So when the market, say, would go up a lot, they were suddenly very skewed towards equity. Or when the market went, the stock market went down a lot, they suddenly had very little in equity. And that's obviously not so.
Interesting. So basically, people didn't used to rebalance, and now they do.
Exactly. It helps them, right? They're not doing it actively, but they're being helped in doing it.
That 1.5 year number is a staggering statistic.
Yeah, that is.
The average is 1.5 years.
Yeah, it's staggering indeed. Unfortunately, you see, there is also, in our data, right, at least this research that we did, it's all people that have a 401k. I can tell you, I've talked to a lot of 401k providers, and they also say there are people that are so maybe uninformed, or, they don't get their act together, and they don't even open a 401k, right? And if you don't, even if you are at an employer that has a 401k and has a match, right, then you are really losing out. And those are things that, ERISA, which is the regulator of the retirement savings accounts, right? Retirement savings system, but also the 401ks, by allowing more default allocations to target date funds, again, is trying to help people to start investing, even when maybe they themselves wouldn't allocate the money in a smart way otherwise.
What about mutual fund flows? How have target date funds affected that?
Yeah, so that's a great question. At least, kind of it's something that's very close to my heart because I've been doing research in it. But actually, what's interesting is if you think about what is a target date fund, right? A target date fund is almost like a construction on top of a set of mutual funds that are equity and fixed income mutual funds, right? And what the target date fund does is, as we were just saying, it rebalances you in actually a counter-cyclical way. So if the stock market goes up a lot, right, and without rebalancing, you would now be too skewed towards equity. What then happens is the target date funds sells some of the shares from the equity mutual funds and buys a bit more from fixed income, right? And the other way around, if the stock market goes down, and therefore you now have less money than you should in terms of, kind of portfolio balance in equities, it actually counter-cyclically buys equities when the market has gone down. That's actually completely the opposite to how the typical retail investor invests in mutual funds, right? We know from a lot of research that retail investors chase returns, meaning that they actually start buying more equity mutual funds when equities have done well, and the other way around, right, when equities have done poorly. And so it has really changed the flow behavior into mutual funds.
How have they affected individual stock prices?
That's also a good question. So what we find is actually so this is, it's of course a market, right, is there's demand and supply, there are changes in prices, so it's an information that people have. So it's not so easy to estimate how some flows, such as targeted funds, affect stock prices, individual stock prices. In aggregate, anyway, is very difficult typically to estimate, right? Because so many things go on in the market all the time. But one thing that we were able to exploit in our research is that actually target date funds tend to be skewed in the stocks that they allocate towards to larger and more liquid ones, right? So they are more likely, say, to be heavily invested in S&P 500, in the, kind of basically largest and most liquid stocks. And so what we are then able to do is to look at stocks where target date funds became really important holders of those stocks and compare them to stocks where target date funds are much less likely to allocate to. And what we see is actually that even in the, just in the last 10 years, when target date funds were growing quite a bit, we see actually that the stocks where the target date funds are very prevalent, their returns are actually now much more stabilized. So basically the up and down, right, the movement with the market of those stocks is muted for those that target date funds are holding. And that makes sense, right? Given what we just said, is that because target date funds counter-cyclically invest money when the market is down in equity, right, and sell equities when equities just have gone up a lot, that then it would make sense that we would see that type of pricing behavior. Yeah. In other ways, you could almost say that it has muted the type of momentum that kind of the type of market-based momentum that we see often, for stocks where retail investors are chasing return.
Would the price effects from target date funds create any arbitrage opportunities?
That's a very good thought. So we looked into this, and ex ante, it could have been, right? But we couldn't find. I mean, so what we at least show in our research is that for the last almost 2 decades, when target date funds were growing, if you were trying to trade against the target date funds, you would have actually lost money. So, kind of, now, of course, who knows, right? Going forward, if they become even bigger and maybe their price impact becomes even stronger, that could change. But we didn't find that you could really arbitrage against them.
And what effects do they have on market efficiency?
So we can only speculate a little bit about this, but it's actually not clear whether they are helping or hurting efficiency. And the reason why I'm saying this is the following. If you think, right, that some market movements, or let's say it this way, in situations where market movements, price movements, right, are based on price revelation and new information, the fact that the target date fund trades against those price shocks actually makes it harder for the information to get into the market, right? And in those situations, actually, they would make markets less efficient because it becomes slower for the price to move where it needs to move, yeah? But if you think that there are also situations where the market sometimes overshoots, right, or there is basically, behavioral reasons or meme stocks, I mean, obviously, there are very few meme stocks, obviously, right? But they can be cyclical movements. Then it might be actually that target date funds increase market efficiency because, right, then they are leaning against these type of overshooting behaviors.
We had a recent guest who drew the distinction between market efficiency and market elasticity. And he was talking about his concerns with the growth of index funds in particular. How do target date funds affect the elasticity of aggregate demand?
Yeah. So we, at least, in our research, we have basically, we think that it actually increases the elasticity of aggregate demand, because there is now much more rebalancing in response to price movements.
Yeah, that's very interesting.